Okay, let's just jump right in. When you think about investing, especially in the U.S. market, putting money into an S&P 500 index fund feels like, like the standard way to get broad exposure, right? It's the benchmark everyone talks about.
It absolutely is. And it seems perfectly logical on the surface. I mean, you're getting 500 of the biggest U.S. companies. Sounds pretty diversified.
Yeah, how much broader can you get? But
Yeah.
if you actually look a little closer, sort of peek under the hood of that standard S&P 500 index, things look maybe a bit different than you'd expect.
Different is one way to put it, maybe even startling for some folks. What we're actually seeing is this incredible level of concentration building up.
Credit's right. We're talking historically high levels. There's this small group of companies, you hear them called the Magnificent Seven sometimes, give or take a name.
The names shift a bit, but the concept holds.
Exactly. And by the end of 2024, these few companies accounted for, get this, over 30% of the entire S&P 500's market value. Over 30%.
That number is huge. And it's not just big in absolute terms. It's historically extreme. Analysts looking back have pointed out that this level of concentration actually blows past what we saw even during the peak of the dot-com bubble back in the late 90s.
Wow, higher than the dot-com era. That really paints a picture, doesn't it?
It certainly does. And that era wasn't exactly known for its, let's say, balanced market structure.
No kidding. So this concentration, it forces us to ask a really fundamental question, I think. What does it really mean when you say you're investing in the market today if just 7 companies are pulling so much of the weight?
And maybe even more crucial, how do the mechanics, the actual rules used to build these indexes fundamentally change what you own and the kind of risks you're taking on as an investor?
Right, because it's not just about which companies are in, but how much of each you own, essentially.
Exactly. Understanding how an index is put together, the weighting methodology, isn't just some, academic detail. It has very real consequences for your portfolio, its potential upsides, its risks, how it's likely to behave.
And that is precisely what we're going to dig into today. We're setting out to really unpack the core difference between that standard way the S&P 500 is built, market capitalization weighting, and a key alternative approach, equal weighting.
We'll look at how they work, the pros and cons of each, why you might lean towards one or the other.
And most importantly, what all this means for you, the listener, trying to make sense of this market, especially with this current level of concentration.
Yeah, the goal here is to help you see beyond just picking an S&P 500 fund. We want you to understand that there are different kinds of S&P 500 funds based on how they're built, and those differences really matter.
All right, let's start with the big one, the standard. Market capitalization weighting. Can you break down for us first what exactly is market capitalization?
Sure. Market capitalization, or market cap as everyone calls it, is pretty simple conceptually. It's the total market value of all of a company's shares that are out there and available to be traded.
Okay, and how do you calculate that?
You just take the company's current stock price and multiply it by the total number of shares it has outstanding in the market. Price times shares equals market cap.
Price times shares. Got it. So it's basically the market's current price tag for the entire company.
That's a great way to put it. It's what the collective wisdom or sometimes folly of the market thinks that company is worth moment to moment. Now, in a market cap weighted index, this number is everything.
How so? How does it determine the index construction?
Well, a company's weight, its influence or share within the index is directly proportional to its market cap relative to the total market cap of all the companies in that index combined.
Okay, so if, say, Apple's market cap is 7% of the total market cap of all 500 companies in the S&P 500, then Apple makes up 7% of the index.
Exactly right. And the practical effect of this is that the companies with the really massive market caps, your Apples, your Microsofts, your Nvidias, right now they have a much, much greater impact on the index's day-to-day performance compared to the companies further down the list.
So a 1% jump in Microsoft's stock moves the S&P 500 index way more than even, say, 10% jump in one of the smaller companies in the index.
Precisely. Their sheer size means their performance dictates a lot more of the index's overall movement. The needle moves much more because of them.
That makes a certain kind of intuitive sense, I guess. The market values them more, so they influence the index more. So given that, why did this method become the standard? What are the upsides that made it so popular?
There are quite a few reasons, actually. First, as you just touched on, it's seen as naturally reflecting the market itself. It mirrors how the market values companies. The index weights align with the collective assessment of importance based on market value.
So it's like the index is just holding up a mirror to the market structure.
In essence, yes. Second, it's relatively straightforward to understand and, importantly, to manage from an operational perspective. The concept is simple: bigger value means bigger weight.
And for the people running the index funds.
Well, the weights adjust automatically as stock prices and market caps change. You don't need constant heavy rebalancing just because prices moved. Major rebalancing, actual buying and selling, typically only happens when companies are added or dropped from the index, or during periodic checkups.
And that ties into another big plus.
Yeah.
Low turnover, right?
Exactly. Because those weights float passively with market prices, there's generally much less buying and selling required compared to other methods that might need frequent trades to stick to specific targets.
And less trading usually means.
Lower transaction costs. Think brokerage fees, bid-ask spreads. All those little costs add up when you're managing billions or trillions of dollars. So lower turnover helps keep fund expenses down.
Which is obviously good for the end investor. And potentially better for taxes, too.
That's another key benefit, particularly in taxable accounts. Fewer trades generally mean fewer realized capital gains being generated within the fund, which often means smaller tax distributions passed on to shareholders. So better tax efficiency is a definite plus.
Okay, so low-cost tax efficiency. What else?
Liquidity is another big one. Market cap weighting inherently favors large companies. And large companies usually have very high trading volumes. Their stocks are very liquid.
Meaning they're easy to buy and sell in large amounts without moving the price too much?
Correct. And an index made up mostly of these highly liquid stocks is itself easier and cheaper to trade. This is absolutely critical for the huge index funds and ETFs that need to deploy massive amounts of capital efficiently.
Makes sense. And originally, before this current bout of extreme concentration, wasn't it also pitched as providing broad diversification?
It was. And look, it still does offer diversification in one sense. You're holding 500 companies across many different industries and sectors.
Yeah.
That's definitely spreading your bets compared to holding just a few stocks or focusing on one sector.
So it reduces single stock risk and single sector risk to a degree.
Yes, compared to narrower strategies. But the catch, as we'll keep coming back to, is that while you own many companies, the weighting method itself can paradoxically lead to high concentration within the index, where a few names dominate the overall exposure.
All right, that's the core tension here. And finally, there's just the fact that it is the standard.
It really is. It's the benchmark everyone uses. The S&P 500, the NASDAQ, MSCI World, FTSE, the TSX in Canada. Most major global benchmarks use market cap weighting. This makes comparisons easy. Everyone speaks the same language, so to speak.
Okay, so a lot of practical reasons for its dominance. Reflects market value, easy to run, low turnover, good liquidity, tax efficient, and it's the established benchmark. Let's make this more concrete. We keep talking S&P 500. Let's dive into those numbers again.
Absolutely. The S&P 500 is the poster child for market cap weighting in the U.S. large cap space.
And that concentration figure we started with really drives the point home.
It really does. It's a direct outcome of this weighting method. Even historically, before this recent surge, it wasn't unusual for the top 10 companies in the S&P 500 to make up, say, 20-25% of the index's total value.
Yeah, I recall seeing data from maybe mid-2021, Apple, Microsoft, Amazon, and Google. Alphabet alone were something like 22% of the index back then. Just 4 companies.
That's right, a huge chunk of performance tied to just 4 names. And now, as we said, the Magnificent Seven, Apple, Microsoft, Alphabet, Amazon, NVIDIA, Meta, Tesla collectively crossed that 30% threshold by late 2024.
And this isn't some abstract historical point. This is happening right now. It shows just how extreme things have become, even more so than the dot-com peak.
Precisely. And it's vital to understand this isn't just a U.S. phenomenon or just an S&P 500 issue. Market cap weighted indexes elsewhere show similar patterns based on their own market structures.
Good point, like the NASDAQ.
Yeah, the NASDAQ composite is famously tech-heavy because tech companies have such large market caps. Back in 2021, tech was over 45% of the NASDAQ's weight. So if you bought a NASDAQ index fund, you were making a massive bet on tech, whether you realized it fully or not.
We're looking at Canada, the S&P TSX composite index.
Also market cap weighted, and it heavily reflects the Canadian economy. You see huge weights in financials, banks, insurance, maybe 30% or so, and energy around 15, 16% historically. So the Canadian index performance really hinges on those sectors.
So these examples show it's a global feature of market cap weighting. It reflects the market's value structure, but that often means concentrating in whatever sectors or companies happen to be the biggest at that moment.
Exactly. It's a feature, not a bug, but it has clear implications for diversification that investors really need to grasp.
Okay, so market cap. Standard, practical, low cost, liquid,
Yeah.
but comes with this major concentration risk, especially now. Let's really focus on the criticisms. What are the big flags people raise?
Well, the number one issue, the one we keep highlighting, is definitely that over-concentration risk. Because the index weights the biggest companies most heavily, its overall performance becomes dangerously dependent on just a few mega-cap stocks.
And the danger is pretty clear, right? If those top 5 or 7 stocks making up 30% plus of the index suddenly underperform, maybe growth slows, regulations bite, whatever.
They can drag the entire index down significantly. Even if hundreds of the other companies in the index are doing just fine, growing steadily, their positive performance can be completely overwhelmed by the negative performance of the giants at the top.
So it actually increases the index's overall risk in a way because your fate is tied so tightly to a few specific companies.
That's the argument, yes. You think you're diversified across 500 stocks, but in reality, you're making a huge concentrated bet on the continued success of that small handful of leaders. The Mag 7 situation is the perfect illustration of this playing out in real time.
Which leads to the related criticism that it gives a skewed representation of the market. It might not really reflect the performance of the average large U.S. company.
Exactly. It's heavily biased towards the companies that have already experienced massive growth and achieved huge market caps. It doesn't give much voice to the hundreds of other solid, profitable companies in the index, or to entire sectors that might be economically important but don't happen to house trillion-dollar giants right now.
So the index's performance might diverge quite a bit from the broader economic health, especially if market gains are being driven by just a narrow group of stocks, which has often been the case recently.
Precisely. It reflects where the market value is concentrated, not necessarily where the broad economic activity or opportunity lies across all 500 companies equally.
Okay, and then there's that more subtle point, the one about potentially baking in a buy high, sell low dynamic into the index itself. How does that work again?
Yeah, this one's interesting. Think about it. A stock does really well, its price goes up. What happens to its market cap?
It goes up too.
Right. And in a market cap weighted index, a higher market cap means a higher weight in the index. So what do the index funds tracking it have to do?
They have to buy more of that stock to match the new higher weight.
Exactly. They're forced to buy more after the price has already risen significantly. That's the buy high part.
And the flip side, if the stock price falls.
Its market cap shrinks, its weight in the index decreases. The index funds then have to sell shares to reduce their holding down to the new lower target weight. They are selling after the price has already dropped.
So selling low. Wow. The mechanism itself encourages behavior that individual investors usually try hard to avoid.
It's an inherent feature of the passive reweighting based on price movements. It's quite a fascinating, if potentially problematic, dynamic.
What about the risk of overvaluation bias? Does market cap weighting push you towards potentially hyped up stocks?
It certainly can. If a stock's price and market cap are soaring mainly due to, say, excessive investor enthusiasm or speculative momentum, rather than purely because of underlying business fundamentals.
The index still gives it a bigger weight just because the price is high.
Precisely. The index methodology doesn't look at earnings or cash flow or debt levels or book value metrics a value investor might use to gauge if a price is justified. It only looks at the market price times shares outstanding. So yeah, you could end up disproportionately invested in stocks whose prices might be inflated relative to their intrinsic value.
And conversely, you might miss out on the potential of smaller companies within the index.
Definitely. Even really promising, fast-grow, smaller companies within the S&P 500 universe will have tiny market caps compared to the giants. Their weight in the index is therefore almost negligible.
So even if they double or triple in value, they barely move the needle on the overall index performance.
Right. Your exposure to their potential upside is very limited within that market cap weighted structure, even though they are technically part of the index.
Are there any other quick limitations worth flagging?
Just briefly, market cap doesn't account for things like a company's debt load, which is pretty important for financial health. It also doesn't always perfectly reflect the free float the shares actually available for public trading versus, say, insider holdings. And as we've said, being price-driven, it can be heavily swayed by market sentiment, potentially disconnecting from underlying business realities in the short term.
Okay, so the standard approach, market cap weighting, lots of practical benefits, but facing serious questions right now due to extreme concentration and these other potential biases. This perfectly sets the stage for talking about an alternative, equal weighting.
Exactly. Equal weighting emerged specifically as a response to these criticisms of market cap weighting, particularly the concentration issue and the resulting bias towards megacaps in certain sectors.
So how does it work? What's the fundamental difference?
It's actually very simple conceptually. Instead of weighting by market value, an equal weighted index gives every single company in the index the exact same weight.
The same weight, regardless of size.
Regardless of size. So take the S&P 500 equal weight index. It has the same 500 companies as the standard S&P 500. But whether you're Apple or the 500th company on the list by market cap, you each get allocated the same proportion of the index's value.
So 1 divided by 500, what's that? 0.2% each.
Roughly, yes. Each company gets a 0.2% weight. It's a completely different philosophy. It says every company in the index matters equally for the index's performance calculation.
Okay, the immediate obvious advantage seems to be solving that concentration problem we started with. It forces diversification away from the giants.
That's the primary selling point, absolutely. It inherently prevents a few mega cap stocks from dominating the index because everyone gets the same small slice. And because those smaller companies within the S&P 500 get a much larger weight than their market cap would justify.
You get more exposure to them.
Yes, you get a significantly different exposure profile with much greater influence from the mid-cap and smaller cap companies within that large cap universe. It offers diversification relative to the cap-weighted approach.
It sounds like a neat solution, but as always in investing, there are trade-offs, right? Equal weighting isn't a free lunch. It has its own set of characteristics and potential drawbacks.
Oh, definitely. It's not just market cap, but better. It's a fundamentally different strategy with its own unique risks and behaviors. While it fixes the concentration issue, analysis, like the work from Northern Trust we looked at, suggests it comes with its own baggage.
Baggage like what?
Well, things like noticeably higher volatility compared to cap weighting, certain implicit risk factor exposures that might not be what every investor wants, sometimes called uncompensated risks, and very significantly much higher turnover. These factors might, for some investors, outweigh the diversification benefit.
Okay, uncompensated risk exposures. That sounds concerning. Can you unpack that? What risks are we talking about here?
It generally means taking on certain types of investment risk beyond just broad market risk that haven't historically or reliably delivered a return premium sufficient to justify taking them on. Factor analysis, often using models like the Fama-French framework plus momentum, helps identify these implicit exposures.
So these models look at underlying characteristics driving returns.
Exactly. And when you run these analyses on equal-weighted indexes versus cap-weighted ones, you see different patterns, different factor loadings.
All right, let's break down those factor tilts for equal weighting based on that kind of analysis. What stands out?
One of the most consistent findings is a significant positive loading on the small size factor, SMB. This means equal weighting inherently gives you much more exposure to the performance of smaller companies.
Which makes total sense, right? Because you're boosting the weight of the smaller firms in the S&P 500 from maybe 0.05% up to 0.2%.
Precisely.
Yeah.
That small cap tilt within the large cap index is a direct result of the equal weighting mechanism.
Okay, small size tilt. Got it. What about momentum, MOM? How does equal weighting interact with stocks that have been trending strongly?
This is where it gets really interesting and maybe counterintuitive. The analysis often shows that equal weighting has a negative loading on the momentum factor.
Negative. So it tends to underperform stocks that have been doing well recently.
That's what a negative loading implies. Momentum strategies try to capitalize on the tendency of recent winners to keep winning in the near term. Equal weighting seems to inherently lean against that tendency.
Huh. So you're systematically selling your recent winners to rebalance back to equal weight.
And buying your recent losers. That rebalancing mechanism itself might be driving this negative momentum exposure. The Northern Trust source described it as potentially flipped or unstable and maybe not desirable if you believe in momentum or want neutral exposure to it.
That's a really key difference in behavior. What about overall market risk? Beta.
Analysis, often looking at rolling periods, frequently shows that the equal-weighted version of an index tends to have a higher beta, market risk, MKTRF, than its cap-weighted counterpart.
Meaning it's potentially more volatile? Moves more sharply, both up and down with the overall market.
Generally, yes. Exhibit 3 in that Northern Trust paper, for instance, visually shows this tendency for higher rolling beta for the equal weight S&P 500 compared to the cap-weighted version over many periods.
So higher risk in terms of beta, plus this tilt against momentum, definitely a different beast. What about the other common factors, like quality or value?
The picture there seems less clear or consistent based on recent analysis. Loadings on quality factors like profitability, RMW, or investment style, CMA, and the value factor, HML, high book to market minus low, for equal weighting are sometimes described as unstable or fairly neutral.
Meaning it doesn't reliably give you strong exposure to those factors.
It seems that way. Unlike strategies specifically designed to target high-quality or value stocks, equal weighting doesn't appear to consistently deliver strong, positive exposure to those potentially desirable characteristics. The main implicit bets you're making are on smaller size and against momentum, along with that higher beta.
So summing up the factor view, equal weight gives you small size, potentially higher market risk, negative momentum, and maybe inconsistent exposure to quality value. These aren't necessarily good or bad, but they are the characteristics you get.
Exactly. They are baked into the methodology. You need to decide if that specific package of exposures aligns with your investment goals and risk appetite.
Okay, beyond those factor tilts, what's the big practical difference in how these funds have to operate day to day? You mentioned turnover.
Yes, higher turnover is probably the most significant practical difference and a major drawback often cited for equal weighting. It's unavoidable.
Why unavoidable?
Because stock prices are constantly changing. As soon as a stock price goes up, its weight in the portfolio drifts above the 0.2% target. If it goes down, it drifts below. To maintain those precise equal weights, the index and the funds tracking it must frequently rebalance.
So they have to actively trade to counteract the market's movements.
Correct. They have to periodically sell the stocks that have gone up, the winners, to trim them back down to the target weight, and buy the stocks that have gone down, the losers, to bring them back up to the target weight. This often happens quarterly, but it's a constant pressure.
Which is the exact opposite of market cap weighting, where the weights just float passively.
Absolutely. Market cap is passive adjustment. Equal weight requires active intervention to force equality, and all that extra
It
trading.
means higher transaction costs,
Yeah.
brokerage fees, market impact costs, bid-ask spreads.
Exactly. Those costs can definitely be a drag on performance over time, potentially offsetting some of the benefits you might hope to gain from the equal weighting itself. It makes equal weight funds inherently more expensive to run than their cap-weighted cousins.
And more trading could also mean more realized capital gains inside the fund.
That's another key point, yes. Especially for investors holding these funds in taxable accounts, the higher turnover can lead to larger capital gains distributions, potentially increasing your annual tax bill compared to a low turnover cap-weighted fund.
And volatility, you mentioned that earlier too.
Yes, studies and analysis like Northern Trust's consistently show that equal-weighted indexes tend to exhibit higher volatility than their cap-weighted equivalents. That higher beta we discussed is one reflection of this. So you might experience a bumpier ride.
Okay, so let's recap equal weight's characteristics. It solves concentration, gives you that small size tilt, but the trade-offs, based on analysis, include significantly higher turnover, higher potential costs and taxes, likely higher volatility, and these specific factor tilts, like negative momentum and higher beta. It's definitely not just S&P 500, but diversified.
That's a very accurate summary. It's a distinct strategy with its own performance engine and its own set of risks you need to be comfortable with.
Right. So we understand the two main structures now. But how do indexes actually, change? Companies get added, dropped, weights get reset. There's a process for this, right? Index rebalancing.
Exactly. Index rebalancing is that essential scheduled process where the index provider, like S&P Dow Jones indices for the S&P 500, reviews the index constituents and their weights and makes adjustments.
Why is this necessary?
Well, mainly to ensure the index stays true to its purpose. The market changes constantly. Companies grow, they shrink, they merge, they get bought, new ones emerge. Rebalancing makes sure the index continues to accurately reflect the market segment it's supposed to track, whether that's large cap U.S. stocks by market cap or an equal weighted version or something else.
It keeps the index relevant and accurate.
Precisely. And accuracy is critical because, as we mentioned, unbelievable amounts of money, potentially $16 trillion tracking the S&P 500 alone, are invested based on these indexes. Index funds have to track the index accurately, so the index itself needs to be maintained properly.
Okay, so walk us through the steps. How does a rebalancing typically happen?
It's quite systematic. It starts with an initial review. The index managers gather and analyze data on companies' market cap, liquidity, financials, sector, etc., to see how they stack up against the index rules.
Then they apply the specific rules, the criteria.
Yes. Each index has its own rule book. For the S&P 500, we know it includes things like a minimum market cap, sufficient liquidity, financial viability, like positive earnings recently, and sector representation considerations.
And based on who meets or no longer meets those rules.
That comes the selection and deselection. They identify companies that now qualify to be added and companies currently in the index that need to be removed. Often, especially for major indexes, there's an index committee that reviews and approves these changes to ensure objectivity.
Got it. Once the new list of companies is finalized, they figure out the weights.
Right, the weighting calculation. Based on the index's methodology, market cap, equal weight, whatever it is, they calculate the precise target weight for each company in the newly constituted index. For market cap, this uses the latest market values. For equal weight, it resets everyone to nth.
And then comes the crucial part. Making it happen in the market. The implementation.
Yes, and this is carefully managed. First, there's usually an announcement. The index provider publicly announces the plan changes, who's in, who's out, typically days or weeks before they take effect. This gives the market time to prepare.
So everyone knows it's coming. That kicks off an adjustment period.
Exactly. During this period, fund managers running index funds and ETFs figure out their trading plans. They know they'll need to buy the stocks being added and sell the ones being removed. You often see trading volume in those specific stocks pick up during this period.
And then D-Day, the execution.
Usually right near the market close on a day before the effective date, the index funds execute their large trades to align their portfolios with the incoming index structure. Then, on the effective date, the index officially starts tracking with the new composition and weights.
Can we use a concrete example, like the S&P 500's regular schedule?
Sure. The S&P 500 has a very predictable quarterly rebalancing schedule. It happens after the market close on the third Friday of March, June, September, and December. Those are the main events.
Well, changes can happen between quarters too, right?
Yes, absolutely. If a company gets acquired, declares bankruptcy, or is delisted mid-quarter, the index committee can make an intra-quarter adjustment to remove it and potentially replace it. But the big systematic reviews are quarterly.
And we had that example from December 2024.
Right. S&P announced that Apollo Global Management, APO, Workday, WDAY, and Lennox International, LTA, were being added. And to make space, Amentum Holdings, AMTM, Qorvo, QRVO, and Catalent, which was being acquired, were removed.
And even though it was just a few companies changing, it still shifted the sector weights slightly.
Correct. The source noted that for that specific rebalancing, financials saw the biggest weight increase due to Apollo, and information technology also had a noticeable shift, just reflecting the relative sizes and sectors of the companies moving in and out.
Okay, so that's the process. What's the actual impact on the market when all this announced buying and selling happens?
The most immediate effect is a big spike in trading volume for the specific stocks being added or removed, especially right around the market close on the execution day. It's purely driven by the index funds needing to transact.
Sounds like a feeding frenzy for certain types of traders.
It can be. Arbitrageurs and specialized traders definitely pay close attention, trying to anticipate the index fund flows and potentially profit from the temporary price pressures.
Does it actually move the prices of those stocks?
Often, yes, but usually it's quite short-lived. Stocks being added tend to get a temporary price bump from the forced buying. Stocks being removed might see temporary selling pressure. This effect is often most pronounced right at the close and tends to dissipate fairly quickly afterwards.
And there's also that sort of intangible effect, right? Getting added to the S&P 500 is seen as a badge of honor.
Absolutely. It's a big validation for a company, brings visibility. Removal can be seen negatively. But again, for long-term investors, these are usually temporary effects. The company's fundamentals will drive its price over time, not just its index membership status.
So pulling this back to the individual investor holding, say, an S&P 500 EPF, what does rebalancing mean for you?
Well, the main thing is that your fund's holdings will change automatically to match the index. The fund manager does all the work behind the scenes. You don't have to lift a finger. Your portfolio just stays aligned with the benchmark.
But you flagged potential tax consequences earlier.
Yes, this is key, especially if you hold the fund in a taxable account. When the fund manager sells stocks during the rebalancing, either removing a company or trimming a winner in an equal weight fund, this can generate realized capital gains inside the fund.
And those gains get passed through.
Often, yes. Funds are typically required to distribute these net realized gains to shareholders, usually annually. So you might receive a capital gains distribution and owe taxes on it even if you personally didn't sell any shares of your ETF or mutual fund that year.
Huh. So passive investing isn't always passive when it comes to taxes, thanks to rebalancing?
It's something to be aware of. It doesn't necessarily change the long-term strategy for most people, but knowing about the rebalancing schedule, like quarter end for S&P 500, can help you anticipate why you might receive a distribution. Higher turnover funds, like potentially equal-weighted ones, might have a greater tendency towards this.
Okay, wow, we've covered a ton. Market cap, equal weight, the mechanics of rebalancing. How do we tie this all together? How should someone listening think about choosing between these approaches?
Well, the crucial point is that there's no single right answer. Market cap isn't inherently better than equal weight or vice versa. The best choice really boils down to your specific investment goals, how much risk you're comfortable with, and what you believe about how markets work.
Market cap is the default, right? It's
Yeah.
the passive way to just own the market as the market currently values it.
Exactly. It reflects the market's collective judgment, warts and all. And it comes with those real benefits. Low cost, low turnover, tax efficiency, high liquidity. It's easy and cheap to implement.
But the big wart right now is that extreme concentration. You're heavily betting on the Mag 7, whether you intend to or not, and you have that potential buy high, sell low dynamic embedded in it.
That's the trade-off. Equal weight, then, is presented as a conscious choice away from that default. It's a specific strategy to deliberately fight concentration and give smaller companies more of a voice in your portfolio.
It offers a different flavor of diversification, but as we discussed, it's not a free ride.
Not at all. You have to accept the downsides. The much higher turnover, which means potentially higher costs and less tax efficiency. You have to be comfortable with potentially higher volatility and those specific factor exposures we talked about, the small size tilt, yes, but also the negative momentum exposure and higher beta shown in some analyses.
So the big takeaway for you listening isn't just, should I buy an S&P 500 index fund? It's, which kind of S&P 500 index fund makes sense for me given how they're built?
Precisely. The methodology matters immensely. Market cap versus equal weight, or other methods we didn't even get into today, fundamentally changes what you own, how concentrated your holdings are, the risks you're taking, and how that investment is likely to perform. Understanding that lets you make a much more informed, deliberate decision that truly aligns with your own objectives.
You move from just picking a ticker symbol to understanding the investment engine you're actually buying into.
Well said.
Okay, so wrapping up this deep dive, we really got into the nuts and bolts today. We started by highlighting that, frankly, shocking level of concentration in the standard S&P 500 driven by market cap weighting, where just a few tech giants hold so much sway.
We looked at why market cap is the standard. It's low cost, it's reflection of market value, but also dug into those significant criticisms, the concentration risk that's so apparent now, the skewed representation, and that quirky buy high, sell low effect.
Then we explored equal weighting as a direct response, a way to force diversification by giving every company, big or small, the same 0.2% weight in the S&P 500 context, leading to a pronounced small company tilt.
But we also stressed that equal weighting brings its own package deal. Much higher turnover, potentially higher volatility, and those specific factor characteristics like negative momentum exposure, according to some key analyses.
And finally, we demystified index, rebalancing that regular process of updating index constituents and weights, explaining how it works, why it's crucial given the trillions tracking these indexes, and its temporary impacts on trading and potentially your taxes.
Understanding these concepts isn't just for finance geeks, it's practical knowledge because the index construction directly shapes the risk and return profile of what's likely a core part of many listeners' portfolios.
So here's the final thought we want to leave you with today, something to chew on as you look at your own investments, maybe that big S&P 500 fund you hold. Given that 30% or more of the standard index's fate is tied to just 7 companies right now, does that market cap approach truly deliver the kind of broad, balanced diversification you thought you were getting?
Or have you effectively ended up making a very large, concentrated, implicit bet on the continued and perhaps historically unusual dominance of those specific few tech leaders? Is that a bet you're comfortable making? Or does an alternative like equal weight, despite its own trade-offs, feel like a better fit for your definition of diversification?
Thinking about how your index funds are actually built isn't just an academic exercise. It directly impacts your portfolio's risk and potential outcomes.
Definitely encourage you to consider these different approaches, market cap, equal weight, and their implications as you review your own strategy. It might just give you a new perspective on owning the market.